Now we're going to talk a little bit about financial statements. This is just an overview of the 4 basic financial statements that we generally use in accounting. Regardless of how small or how large your company is, you usually will do some version of all 4 of these statements. First of all, the income statement. The income statement is, in essence, just that. It is the statement that helps you to determine the net income that your company has over a particular period of time. Obviously, sometimes it is not income, it is a loss. So it's going to determine the net income or the net loss over a period of time. In accounting, we always have annual statements, but often people will do monthly and quarterly statements as well. So an income statement is going to give you a list of all of your revenues and a list of all of your expenses. It's going to subtract expenses from revenues, and it's going to come up with either a net income or a net loss. The statement of retained earnings will explain the changes in your equity from one period to the next. Remember, what we talked about in the last video is that you have either a net income or a net loss, but you also may have more money that's been invested into the company. You may have dividends that have been paid out. So the statement of retained earnings starts with the beginning retained earnings and will add any new investments that have been made into the company. We'll add to that any net income or subtract from that any net loss. And then it will also subtract any dividends that have been paid during that particular period of time to arrive at the retained earnings at the end of that particular period. A balance sheet is different than either of those two things because it's going to list all of your assets, your liabilities, and your owner's equity. And again, this is where it has to balance. That's why it's called a balance sheet. The total of the assets is going to have to balance or equal the total of the liabilities plus owner's equity. And this basically describes a company's financial position at the end of each particular period. But it's only at that one point in time. It's only on that particular day. So if you have a statement for December 31st, it's going to show you where that company stood on December 31st. But if on the next day the company sells a piece of land or incurs another liability, it's going to change the balance sheet. So it's a snapshot of a particular point in time of that company. And a statement of cash flows is a little more difficult to understand. It's trying to just focus on cash flow, and it's going to identify the inflow and the outflow over a particular period of time. So let's talk about those in a little bit more detail. Let's just look at the examples given at the bottom of, I think we're actually on page 21 in the textbook at this point. This is an income statement for a company called Fast Forward. It is a pretty basic one. Income statements can be extremely involved, but this is just showing you basic revenues and expenses that this company has. This company has 2 different sources of revenue, consulting revenue and rental revenue. So their consulting revenue for this period, now for the period of time that we're talking about, you have to look at the top of the statement. So this is for the month of December 2013. They brought in $5,800 in consulting revenue, $300 in rental revenue, for a total of $6,100. Their expenses for the month were just 2 different things, rent expense and salaries expense, for a total of $1,700. So the net income for the period is $4,400. Now once you have the income statement, you can then move to your retained earnings statement. Now we're assuming that this company had no retained earnings at the beginning of the period, and that would have been explained up here. The net income for the period. Now we've taken revenue minus expenses, so this is our net income. So we now add to that $4,400. But then there is a dividend being paid out of $200, so you have to subtract that. So the retained earnings at the end of this particular period is $4,200. Now, once you have done the income statement and then the retained earnings statement, you then use this information and it gets put onto your balance sheet. Now remember, balance sheet, assets on one side, liabilities and equity on the other side. They have to balance. If they don't, something is off in your financial statements. So the assets, this company has cash now of $4,800. It has supplies worth $9,600 and equipment worth $26,000 for a total of $40,400. Now when I say this is what these are worth, going back to the cost principle, this is what would have been paid for these things. It does not mean that the guy could turn around tomorrow and sell these supplies for $9,600. We don't know what he could sell them for. But he paid $9,600 for these supplies and $26,000 for this equipment. So these assets are recorded at cost. Now, your liabilities. Remember, liabilities are the claims against the assets. Outside claims, meaning you owe this to somebody else. And internal claims, which means this is what the owners have claim to. This is what's left over after the liabilities are taken care of. In this case, the only liability is accounts payable for $6,200. And then the equity. The equity is made up of common stock, which means that this is what the owners invested in the company. But now you add to that the new retained earnings that they're choosing to reinvest back into the company for a total of $34,200. If you add liabilities and equity together, $6,200 plus $34,200, you get the same amount of the total assets, and this is exactly what you're looking for. Now, statement of cash flows is going to, what you should end up seeing here at the end of the statement of cash flow is you should end up seeing a cash balance that is equal to the same amount that you put on the balance sheet. These two figures should be the same. Cash flow is divided into three different categories, and this is a little advanced for a brand new accounting student, but just very basically, cash flow is divided into what comes in from operating activities, what comes in from investing activities, and what comes in from financing activities. And understanding what is an operating activity, an investing activity, and a financing activity can be a little difficult in the beginning, so don't worry too much about that at this point in time. However, once you've divided those things up, cash coming in, cash received from clients, is a positive number. Cash being paid out would be a negative number. So that's why you see these brackets around these things. So as you can see here, this one's pretty obvious. Cash received from clients, money coming in. Cash paid for supplies, rent, and employee are all negatives. So net cash provided by your operating activities in this case is $1,000. Cash flows from investing activities. In this case, you're investing in your equipment, but this is not money coming in, it's money going out. That's why it's a negative number. So that's why you have a negative number here. But the cash flow from financing is, in this case, the stockholders have invested money into the company. They invested $30,000 in cash. Only $200 was paid out in dividends, so the net cash provided by financing is at $29,800. Therefore, if you add these three numbers together, you get a net increase in cash of $4,800. There was no cash available at the beginning of the month, so there's nothing to add to that. So in this case, the cash balance at the end of the month is $4,800, which is the same as what we have up here on the balance sheet. So those are the four basic statements. Again, in this case, probably for our purposes, the most important ones are understanding the income statement and the balance sheet, and then from that, the statement of retained earnings. But if you can understand how to do these two statements, I think the rest of it will pretty easily fall into place for you.